Welcome to the Innovators and Investors Podcast. I'm Kristian Marquez, founder and CEO of FinStrat Management. At FinStrat, we provide CFO-led accounting, finance, and reporting services to assist clients monetize their business. Stick around to the end of the podcast and I'll share how you can be our next guest. Now on to the show. Hello, and welcome to another episode of the Innovators and Investors Podcast. I'm your host, Kristian Marquez, founder and CEO of FinStrat Management. Super excited because today we have with us Les Craig, general partner, Next Frontier Capital. Les, welcome to the show.
Thanks, Kristian. It's great to be here.
Super excited to have you. So let's get it right into it. Next Frontier Capital, what's the investment thesis?
Yeah, so we are headquartered in Bozeman, Montana, which is where our firm was founded, and we now have offices in Salt Lake City in Utah, and then in Boulder, Colorado. And between those three offices, we invest in early stage companies in the Rocky Mountain region. So think of it as pretty much the Western U.S. minus California, but really a focus on Colorado, Utah, Montana, Idaho, Wyoming, and New Mexico to date. So.
And what's the rationale of focusing on the Mountain West, and then perhaps just as important, excluding California?
Yeah, and don't get me wrong, we love our founders and our funders that live in California, that are from California. But frankly, to get to the point, that's a place where there's always, as long as there's been venture deals, there's always been access to capital the whole way up the chain, right? From the earliest of stage all the way up to growth stage. So why the Rocky Mountains? If you look at startup activity across the country, and especially post-COVID, there's been a significant uptick in activity, in success in this region. And historically, it hasn't always been a place where there has been access to capital, especially at varying stages, the earlier stages in particular. And if you think about the amount of talent that has moved to this region, the amount of great companies and great founders that are here, but still seeking that seed to Series A stage capital. There's not a whole lot of firms in this region that have raised funds, especially recently, that service that area, especially on a per capita basis or on a per capita startup basis. We tend to think of ourselves as serving the best founders in this region. Our goal is to help get them to the milestones where they can attract growth stage capital from a nationwide view of other firms that are out there, coastal firms that are out there for Series B and beyond.
On the surface, it seems a bit counterintuitive in so much as for anyone who's visited the Mountain West, it's paradise. It's absolutely gorgeous. And my sense is that it attracts a lot of professional investors. And so do you see, especially post-pandemic, that there's this change taking place where you're finding a lot more professional money managers calling the Mountain West residents?
For sure. Yeah, certainly there's firms that have, there's partners originally that have sprouted up here, and then even some new firms. It's funny, when our firm started in 2015, we were the first and only venture capital firm in Montana. And now there's another one up in Whitefish, Two Bear Capital. And that's in terms of firms that have a headquarters or headquarter presence. But aside from that, there are general partners from you name it, just about any tier one firm that either have second homes in Montana and or live here permanently. But I would say, and that's just using Montana as an example, the thing we really pride ourselves in, though, is not only being in the Rocky Mountain region and living here, but just really having this love for place that it transcends really beyond where our headquarters are. I just got back from last week. I was in New Mexico pretty much all week. Incredible ecosystem there. We don't have an office there, but we pride ourselves in being present, spending time, not just being venture tourists that come once a year for the one event, but really try to make time to spend time with founders and be present in all of the states in our region.
So on that note, one of the consequences of having ready access to capital in the Bay Area and New York City is that an argument can be made that it impacts valuations to the detriment of funds and ultimately limited partners. And so I'd just love to get your perspective of how you found that's benefited investors who focus on companies in regions outside of San Francisco and New York.
Yeah, it's a great question, and it's one that we get a lot. I think typically the way people ask it is like, are deals cheaper because they're in the Rocky Mountain region? And I don't think that's even the right way to characterize or ask the question, because I think what's more appropriate to ask is, how do you think about investing? How do you think about writing checks in the Rocky Mountain region? And for us, it really goes back to a calculus and an understanding of who the founder is, what their ambition is, and the reality of you take a great founder in the Bay Area versus a great founder in Bozeman, Montana. In Bozeman, they're probably going to be able to get going for a lot cheaper than they are in San Francisco. And it's comical because it's even gotten more expensive in Bozeman. But the reality is just to hire the engineers, hire your basic team, especially in a place like maybe Boise or maybe Salt Lake City, it's generally going to be more capital efficient environment, I think, to grow an early stage team. Now, the benefit that the Bay Area has is you got a lot more concentration of talent, but increasingly that's becoming easier to attract those people to the region for lifestyle and wanting to raise families and things here. So we think about it as it's not so much is it cheaper or are the deals cheaper? It's just it takes less money to hit those proof points, I think, in this region. And then second to that, which I think is a really important philosophically, our fund is focused on a very specific strategy, and that backs into a very specific fund size. Our current fund is, I say, only 102 million. I know that sounds like a lot, but given our strategy of investing in seed to Series A stage companies, that's the right size for a fund in our region, writing entry checks in kind of the $2 to $3 million range to build out balanced portfolio. That's the right portfolio strategy. The problem that some of these Bay Area firms, like, why are these deals so expensive? If you have a $250 or $400 million seed fund that you're writing checks out of, which sounds crazy to me, people do it. Generally, that means you've got to deploy big checks. Maybe your entry check in a pre-seed stage company might be like a $10 million pre-seed round where the company has no proof points, no traction, nothing. And you're going to basically give them 3 years of runway to build a product, try to go to market. And so why do companies end up in the Bay Area getting on what I would like to call the hamster wheel of death, where you're just like always trying to catch up with your last post money? It's because in a lot of cases, check size, the mandatory check size of these early stage firms, they could care less what the valuation is. They need to deploy the dollars. They need to get certain ownership. That creates what I think is unfortunately can lead to kind of some toxicity in early stage culture where people think that's normal, but it actually becomes I think a kiss of death for some firms. It creates this binary or bust kind of outcome.
Yeah, it'd be interesting to take a look at revenue profiles for two companies, one in the Bay Area and one in, say, the Mountain West at the same stage, and see whether or not there's a material difference. I bet you they're very similar. But then, as you point out, getting a lot more money in the Bay Area is going to create a different valuation and a different set of expectations.
Yeah.
That are going to be harder to manage. Great point.
The other thing, just to put an exclamation point on that too, the other thing that happens is, and I think this is unfortunate, and it's still a challenge in our region, but we're working through it through what matters and through performance. And now more than ever, I think performance and focusing on business fundamentals and efficient growth versus growth at all costs is important. But the other thing that happens is sometimes there's a star power that comes from these tier one Bay Area firms where whoever led your pre-seed is just because they're on your cap table and feel at the same level of metrics and at the same level of progress. Some firms will lead in, some firms will even issue term sheets to companies that regionally, or if they were more scrappy or bootstrapped at the regional stage, they just won't even take a look. And so there's this star power thing that the Bay Area still has. I think increasingly that's hopefully going away as business fundamentals matter more than who's on your cap table.
For any of our members of our audience who are from Carta, there you go. You got an analysis to go run for us and put them in the follow-up comments to the show notes. We'd love to hear Hey, so let's change gears a little bit. Would love to hear how your career path took you to Next Frontier.
Yeah, as I like to give advice to anybody who's aspiring to get into venture capital, someday don't plan it. Have a career that's progression that's weird as hell. And maybe if you're fortunate enough to find yourself with an opportunity to be at a venture capital firm someday, I think that's the best way to do it. So my background, I was applied math, computer science major out of West Point in 2003. The Army put those, it's funny, at the time, my academic advisor, he's like, why would you want to do computer science and math? Like that those two don't go together. I'm like, I like computers. So anyways, like precursor to data science. We used to call them ORSAs, operations research and statistical analysts. But yeah, I was basically an ORSA in my undergrad. Army put those skills to great use when I was commissioned as second lieutenant in the infantry branch. So I spent 5 years on active duty and special operations as a Ranger platoon leader, an aide on General McChrystal's staff, got out of the Army, spent a year at Johns Hopkins Applied Physics Lab, where I did get back to some of my cool fundamentals, doing some geospatial analytics, building products for the counter IED fight in Iraq and Afghanistan, I guess a little bit at that time in '09. I spent a year there, '08 to '09, and then I was a tech ops officer at the CIA for almost 3 years, where I did fun stuff. We'll leave it at that. And then in fall of 2011, a good friend of mine from active duty service, he was General Alexander's aide at NSA when I was McChrystal's aide at JSOC. He was starting a company and wanted to know if I wanted to be a co-founder and run the technical team, run the product team. So I did that. The company was called Red Owl Analytics, venture-backed, ran really hard for a couple years, about 2.5 years. And then I was also working through just some personal stuff and an old injury that I had from when I was on active duty and got really burned out and needed to get well. And went through a series of programs in 2012 and 2013. And as I started to get healthier, I realized that the company was just not helping that cause and decided to step away right before we raised our Series B. And that's when I got a job at Montana State University. I ran the Blackstone Launchpad at Montana State University in lovely Bozeman, Montana, and started there in January of 15. So coming up on 10 years of being in Montana, this January will be 10 years, which is exciting. But it was through all of that craziness of a pinball machine that was my early career. It was through those experiences that I ultimately got connected to Will Price and Richard Hargis, the founders of Next Frontier Capital. At the time, it was a $20 million fund. First fund, there was a lot of adjacency with some of the stuff I was doing at the university and what they were doing with the firm and strategically in the ecosystem. And in 2017, December of 17, so I'm coming up on my 7-year anniversary at Next Frontier Capital, I joined the firm as the first non-founder, non-managing partner, really which was exciting to me. It was really a recognition that Will and Richard had of building not just a business that they would pick and choose a few investments each year, but a business with endurance that would last generations of investors. And that was a really exciting concession, and that they made bringing me on the team to help really build up our sourcing operations and our just everything operations. Everything from being the janitor, I feel like, to actually leading my first deal in 2019. And so it was really a wild path, but grateful for the opportunity and learning the industry on the investment side from them, and their approaches to molding me were really special. It was a exciting and wild ride that ended, and now I've invested in 13 companies now, and I'm on 8 boards. It's come a long way over the past 7 years at the firm.
Super unique background, really exciting. And if you happen to know what happened to JFK, we're all ears. But would love to understand the lens by which you look at potential investments.
Mm-hmm.
And would also love to hear how your time as an operator influences how you're looking at these companies.
Yeah, interesting. Great questions. I will say this, my lens has changed significantly over the years. And I would say, I'll answer the second question first, because initially I was biased by my lens as an operator. And as an operator, I thought about primarily 2 things. So I ran the product team. I was the VP of product at my company. I hired our first engineers, hired our CTO. And then I also ran analytics teams. I ran PhD data scientists that were building all of our algorithms. So the lens that I had as an operator was the best technology wins. Something novel, something unique. And most importantly, and I had a consulting business for a little while too, between Red Owl and starting NFC, a data science services company called The 20. And most important principle of that entity was, if you want to do something creative and analytical and build some cool tech, we would really consult people to understand, what is the business value first? What business questions are you asking? You need answers to, and then this whole litany of other things. Do you have the data? We did a lot of really cool consulting projects there, from litany of customers, everything from government customers to publicly traded company. But anyway, that was the important stuff to me. It was like solving a crazy cool problem with real business value using unique technology. And so that was important to me. And then the other side of it that I realized, because in my first company, as I focused on product, eventually I couldn't understand why these idiot salespeople that we had couldn't sell the damn product. By the way, one of our fun story, one of our most successful, finally successful VPs of sales at Red Owl Analytics, dear friend, one of my dearest friends, Michael Madden, founded Atata, which was the first NFC investment that I referred to the firm, and also ended up being our first exit. So I say this with the utmost respect for our salespeople at Red Owl over the years. But what I started to do, and our CEO started bringing me in, I started to run our customer success element, because what I found was that we could build the most beautiful, amazing thing possible, and solve a business problem that we were aware of, that people were telling us. But if we weren't close to the customer, and if we weren't actually closing deals, like paid deals, if there was no revenue, we might as well just build a pier out into the ocean with all this venture capital. There was no bridge to the next thing. So those are like some of the biggest lessons I learned as a founder. And early on in my investment career, those were the things that I feel like I really overemphasized, was like, what is this tech opportunity? Like, looking at the timing of that opportunity, wanting to see real traction, product market fit, wanting to see revenue, wanting to see customers. And I focus so much on the reference. I love doing diligence. I'm a nerd, and maybe I get it from some of my CIA background, but I obsess over customer references and diligence and back channels. And I do some really creative secret stuff there. Not super secret, just some fun stuff. But those were the things that were important to me. And the things that I overlooked, I think, early on in my investment career, was how fundable is the founder, and also how confident am I in the founder's ability to attract the best people imaginable in the universe of people for this company. How confident am I in the founder's ability to attract those tier 1 A+ rock star players to the team, such that as soon as we close this investment, those people are hired? And the reason why I overlooked those things is because I thought fundability in a founder it's more about the progress of the business. It doesn't matter how good they are at fundraising. It doesn't matter how good they are at running fundraising process. And besides, that's one of my superpower. I love doing that stuff. I used to love doing that stuff at Red Owl. And so I can help. I'll help them with that. And boy, was I wrong. Boy, has that been a challenge. And the reality too of my network only goes so far for referrals and people that I can bring into these companies. And for the earliest stage companies, like literally founders, one of my favorite things to ask founder is, tell me the 5 people you're going to hire as soon as you close this round. Who are they? And if they're like, I need to hire a CRO, I'm like, who is it? Who is the CRO? Like, from your network, send me his LinkedIn. Who is the person? And if they're like, maybe you could help me resource that person, I'm like, yeah, maybe I could. And I probably have somebody in my head, but I'm not interested. Like, I've gotten very disciplined when it comes to this, because these two things, when you're an early stage company, and I think firms tend to over-index on a lot of really stupid stuff. My favorite is, oh, we just want to see another quarter of ARR increase, and the year-over-year growth number isn't quite listed. This company is doing $600K in ARR. They might as well be doing 0, because it makes about the same difference in terms of the inflection point of the company. And some people are like, oh, we want to see at least $1 million. I still go to the fact is $1 million is peanuts. 3 million is peanuts. Like, I've seen companies go from 3 to 7 million in ARR in a year, and you're thinking it's this is going to be the next greatest thing. And then guess what? Founder can't close a Series B. Well, why? The market, everything that they got, all the metrics, like, they're not fundable. They don't know how to run a fundraising process. They're not fundable. It's a skill. It's an intangible skill. It's difficult to assess, but it's one of those things. First of all, you know it when you see it. And number 2, the greatest sign that a founder is fundable is when you are running a process with them and they are running a process towards convergence. There is competition in the deal. When you get a deal and nobody else is competing for it, you might want to pay extra attention to some of the details around how fundable this founder is. Because if you overlook it, you're going to be dealing with it at the next series.
Interesting. Curious, how often do you find that you're running into founders who are pitching you and just really have no concept that there has to be a follow-on monetization within a certain time frame?
I try to be I try to be super helpful and just educative with founders in our region in particular, because I think there's a lot of founders just in general, but especially in our region, that should never be raising money, should never be doing it. And they may be visionary, they may be incredible technologists, they may be great people that have incredible careers ahead of them. But like fundamentally, if you're not good at raising money, either find somebody who is and have them join your team, or pursue an alternative path, pursue an alternative way of building the business. A CEO's job is to fundraise. Literally, the successful CEOs are, and this is of an early stage company, right? Don't take that quote and make like a meme of me. It's really no, that's not independent. It's like Series Seed to really, I would say Series B. Your job is to fundraise. Once you get to Series B, it's more growth, it's more metric based, and it's a different game. But that is your job. And if you're not doing that 80% of the time, all the time, and sometimes 110% of the time, all the time, you're not actually being a CEO. You're doing something else, which is probably what you should be doing for the company, like product or CTO but like a CEO's job is to fundraise. That just bluntly said. And the other thing that's related to this is, and you hinted at it a second ago, the timing of how quickly the cycles of funding. Remember, this isn't a lifestyle business in this industry. And as soon as you feel like, oh, I'm funded, now I can start running this like a lifestyle business again, you're dead. You might as well just get off the hamster wheel. It's over. It's done. It's more about pacing and growth. This is the purpose of raising money, isn't to hire new people. It isn't to give everybody a raise. It isn't to get a swanky office and a ping pong table. The purpose of raising money is growth. And if that's not your mindset, don't raise money. But you have to be, and I'm not saying growth at all costs. That's bad.
Yeah.
But it has to be a growth mindset. And you have to show, it's like the stopwatch starts when you take the money. You got to demonstrate the growth responsibly. And I like to tell founders, if you're not back out on the road with interest, with serious interest that you've been courting all along since you closed your last round, 9 months, if you're not back in market, probably you're not a great company. 12 months, and it's like, whoa, wait a minute, Les, we got 18 months of runway. No, exactly. 9 months, you should be in market. Oh, Les, we got 24 months of runway from the last fundraise. If you wait 24 months to raise, you're not going to raise. I don't care how amazing you are, how amazing your technology is, you're off the venture tracks. And so I like to say 9 to 12 months is the right amount of time to be going to market, getting a term sheet. 12 to 18 months is you're still good. You're still on those rails, but like maybe one wheel is starting to slip off. You go beyond 18 months, you go into 2 years. Oh, well, yeah, our last round was 3 years ago. People just aren't going to take meetings with you. This is the reality. And what I'm increasingly encouraging founders to think about is, if that's where you end up, that's okay. Stuff happens, right? But rather than have this false sense of security around next quarter is going to be different, or we just need to once we get our net retention up above 100% and we post 100% year over year, then the VCs will want to see us. Then they'll want to take the meetings. Guess what? Your last fundraise was 4 years ago. Nobody's going to take a meeting with you. Either find some alternative ways to solve your capital problem, or change the business model in a way, or change your growth muscle in a way that you're profitable, or you have some sort of way to organically grow. Or guess what? You can sell the company, and that's okay too. But clinging on to this false sense of we're going to make it and we are already off the venture rails, it's not reasonable. So
Yeah, it's just this theme is, what's the definition of make it? And a lot of times I get the sense that founders go into a fundraise thinking that the future vision is a unicorn, not realizing that totally respectable to get singles and doubles. And sometimes it's just a business that you find yourself in.
Yep.
And I'm curious, while we're on the subject, time frame, do you feel like it's the same seed to A to B?
You mean time frame in terms of the how condensed 9 months? I don't think it's I'm not going to be super prescriptive on the time frame because I think it really depends. It does depend on the industry. And when I say if you're not going to market 9 months, what I'm really referring to there is like after your seed round. The thing is, the A is like the puberty round of private equity, I think, like in or venture, whatever. It's the seed round. Pre-seed, it could be you could bootstrap it for an eternity. Pre-seed, you could raise some angels and then you tell people like, oh yeah, we started the company on this date. So it's like there's fuzziness around pre-seed. Seed to A is really this range that I think is a critical one. And that's the one that I'm mostly characterizing. Beyond A, it becomes like when you're raising a B, it does become more metrics driven. So I think it's more forgiving. But what I'm characterizing is really this seed to A stage, which is just it's tough. It's an awkward time, but you you can't screw it up or it's hard to recover. Did that answer your question?
It does. I think for the founders in our audience, you just have to be cognizant. It's not one size fits all. And
Mm-hmm.
having an understanding that your investors are going to have different expectations depending on where you are in your trajectory, it makes all the difference.
Yep.
And,
Speed is your friend though. And it's funny because I think back when we raised the Series A at Red Owl, oh my gosh, it was a disaster. Like I did the Sandhill Road Tour, I pitched Greylock and Formation 8, and it was super fun. And we Allegis, and we had a blast doing it. Got a term sheet, didn't end up. There's a long story what ended up happening, but like the company we almost died. I think we were burning like 300K a month. We had 900K on the balance sheet, and the deal kind of blew up. And then we ended up putting a round together and getting saved by the skin of our teeth. And that kind of stuff just, I feel like that doesn't happen anymore or very often. And we got very lucky, but I think and the reason why we got lucky is because like things ended up dragging out. When things drag out to like the end of your runway and you're totally delevered and it's people just give up on you. And I know it sucks. It's unfair. I felt it. I remember it. But we got a Hail Mary pass and we caught it. And that's a whole funny story for another time. But that's the thing. It's time is your friend and you get one shot at if you run a process for your A and you get to the end and you're just like left at the altar and should we keep running this thing? Like, yeah, actually, probably not. Like it, time is your friend. So the faster you build that momentum and run that process, the better.
yeah, it's a hard decision to make, especially after you've invested so much time, energy, emotional capital into what's effectively your baby, and then only to find out that no one's interested in it. It's
Yep.
hard. It's hard, but sometimes necessary decision.
Yep.
Hey, I see we're close to the end. Before we wrap up, and I think your last comment, great dovetail into the current market environment. For benefit of our audience, we're recording this here coming up on Thanksgiving 2024. So post-presidential election, would love to get your take as to what for the road ahead.
Anecdotally, I'll say I look at our firm's activity from like Q4 of 2022 to Q1 of 2024. So like a little over a year time frame. I think we closed two net new investments, maybe three, and then since then we've closed eight. Just to put that into perspective, it's or maybe seven. Yeah, I think it's seven. About maybe by the time this airs, maybe eight. But my point, anecdotally, I can say I feel like the momentum has picked up, like boots on the ground for us. I would say though, the thing that is still critical for founders, the best piece of advice I can give you is you should be having conversations with probably 60 plus VCs and expect that will lead to one term sheet. So widen that aperture, have a lot of conversations, and don't start having the conversations if you're like, oh, less than 9 to 12 months in, I need to start running my process. That's when I need to start having those conversations. No. You just closed a round. Guess what? That's great momentum to say, look at me, look how awesome my company is. Next Frontier Capital just led our seed round. we love you guys as an A firm. Let's have a conversation. We're going to be ready to do that in 9 months. Like that sort of ambition as a founder is probably the best piece of advice I can give you to set you up for success.
Les, been an awesome podcast, super insightful. I know my opinions our audience is going to benefit, especially founders, getting your perspective on fundraising. If there's anyone who wants to get a hold of you, whether it's a founder, co-investor, or limited partner, how can they find you?
If you want to find some of my content, you can check out Found in the Rockies, which is a podcast about the startup ecosystem, the founders, funders, and contributors in the Rocky Mountain region. Other than that, I'm on LinkedIn, Les-Craig on LinkedIn. And otherwise, if you want to email me, you can find me at les@nextfrontiercapital.com.
Fantastic. Les Craig, General Partner, Next Frontier Capital. Les, thank you so much.
Thank you, Kristian.
And that's another episode of the Innovators Investors Podcast. Thank you for tuning in. Kristian Marquez here. Thank you so much for listening to the Innovators and Investors Podcast. If you're a successful founder or an investor who would like to be on the podcast, please visit podcast.finstratmgmt.com/podcast-guest. If you've got something out of this interview, please share this episode on social media. If you know someone that would be a great guest, please tag them on social media to let them know about the show and include the hashtag Innovators and Investors. I'd love to see your posts and suggestions. We're regularly putting out new episodes and content. To make sure you catch each new episode, please subscribe to the Innovators and Investors Podcast. And your thumbs up, ratings, and reviews go a long way to help promote the show, and it means a lot to me and my team. Would you like to know more? Go to our website, finstratmgmt.com, or follow us on LinkedIn or on X. Our handle is @finstratmgmt. This is Kristian Marquez. Thank you for listening. Until next time.